Our group has conducted a comparative financial statement analysis of three major Indian cement companies: Ultratech Cement, Shree Cement, and ACC, covering fiscal years 2023 through 2025. In line with the project guidelines, our analysis is based strictly on standalone financial statements sourced from audited annual reports. No external assumptions, adjustments, or recomputations have been made. Methodologically, we have applied the core frameworks discussed in class. This includes ratio analysis across profitability, efficiency, and leverage metrics. DuPont decomposition has also been done to understand the underlying drivers of return on equity, and both horizontal and vertical analysis to study trend movements and structural changes in the financials. All ratios and outputs were calculated manually in Excel with formulas directly linked to the balance sheets and P&L statements to ensure traceability and accuracy. With that context, we will now walk through our key findings.
So, firstly, we'll talk about industry context. Before interpreting our ratios, it's essential to understand cement industry's structural characteristics, which directly explains the financial patterns we observed. First, cement manufacturing is extremely capital intensive. This explains why we see such dominant fixed assets balance across all three companies. Substantial PPE and capital work in progress consistently dominate total assets. Second, the industry exhibits high operating leverage with large fixed cost profitability becomes highly sensitive to volume utilization. This is why we observe significant EBITDA margin volatility despite relative stable revenue growth. Third, as a commodity business, companies face limited pricing power but volatile input cost for power, fuel, and logistics. This makes efficiency and cost control the primary competitive differentiators rather than product innovation. These characteristics will help us interpret why certain ratios behave the way they do. So now we will talk about revenue growth and scale. Applying horizontal analysis to revenue from operation reveals stark scale differences. Ultratech demonstrates massive absolute scale with FY25 revenue of 75,955 crores, approximately 3.7 times of ACC and 4.2 times of Shree Cement. More importantly, Ultratech shows consistent year-on-year growth momentum. In contrast, our peer companies display volatility. ACC rebounds in FY25 to 20,710 crores, surpassing Shree Cement at 18,037 crores. Shree Cement's decline from its peak FY24 peak potential operational challenges that we will examine through our ratio analysis. This revenue scale matters because in a capital intensive, highly fixed cost industry like cement, larger scale typically translates to better cost absorption and better bargaining power with suppliers.
Shree and Ultratech showed relative resilience but still trended downward. However, EBITDA margins, which measure operational efficiency about accounting for all the operating expenses, tell a more nuanced story. Ultratech achieved remarkable recovery from just 6% to 7%, demonstrating successful cost management and operating leverage benefits despite gross margin pressure. Shree Cement exhibits the highest volatility, peaking at 26% in FY24 before dropping at 16% in FY25. This volatility reflects the cost sensitivity we discussed earlier. It's a defining characteristics when you have high fixed cost and commodity pricing. This margin analysis shows that not all companies responded equally to the same external cost pressures, indicating different operational capabilities. So now we'll talk about profitability ratios. Now examining our calculated return ratios ROA and ROE, which measure how effectively each company generates returns from its assets and equity. The standout finding is that ACC Cement, which nearly tripled its ROE from 5.6% to 13.1% over this period, this improvement significantly outpaced peers and makes ACC the ROE leader by FY25. Conversely, Shree Cement shows concerning volatility, peaking at 12.858% in FY24 before collapsing to just 5.8% in FY25, more than halving in 1 year. This deterioration warrants deeper investigation through our two-point analysis. Ultratech maintains relatively stable returns around 10 to 12%, reflecting the stability benefits of diversified scale operations. What particularly interesting is that ACC achieved ROE leadership despite being much smaller than Ultratech Cement. This suggests that efficiency advantages we'll explore next.
Let's talk about efficiency analysis. Our asset turnover ratio calculations reveal significant efficiency differences. ACC consistently maintains the highest asset turnover, ranging from 0.82 to 0.98 times, indicating superior revenue generation capability relative to its asset base. This is remarkable given that ACC is the smallest company by scale. Both Ultratech and Shree Cement declined from 0.74x to 0.65x in FY25, converging at nearly identical efficiency levels. This decline likely reflects the asset side denominator effect, recent heavy capital expenditures for capacity expansion that haven't yet fully ramped up into proportional revenue generation. This is typical during expansion phases. From a DuPont perspective, this efficiency advantage partially explains ACC's strong ROE performance despite moderate leverage. They're extracting more revenue from each rupee invested in assets, which directly flows through to returns. Leverage and solvency. Analyzing capital structure through the equity multiplier shows different financing strategies. Ultratech employs the highest financial leverage at 1.75 times, using debt aggressively to fund its scale expansion strategy. This is consistent with their revenue growth trajectory we saw earlier. Shree Cement operates more conservatively at 1.33 times, having shifted toward an equity heavy structure over this period. ACC maintains stable, moderate leverage at 1.39 times. From a solvency perspective, all three companies remain well within acceptable ranges, no distress indicators. However, leverage is a double edged sword. It amplifies returns when operations perform well, but also magnifies losses during downturns. Ultratech's higher leverage will be a key driver in our DuPont analysis.
Applying the DuPont framework, which decomposes ROE into net profit margin, asset turnover, and equity multiplier, reveals the strategic drivers behind each company's performance. ACC Industries reading 13.1% ROE is clearly margin driven. Their net profit margin expanded dramatically from 4.1% to 11.5%, exceptional operational improvement. Combined with the highest asset turnover of 0.82 times and moderate leverage of 1.39 times, this delivers superior shareholder returns. ACC's success comes from operational excellence. Ultratech's 10% ROE relies on the different formulas. They use highest financial leverage 1.7% times to compensate for lower rate margins of 8.8% and asset turnover of 0.65 times. Essentially, Ultratech is using financial engineering and scale advantage to maintain competitive returns. Shree Cement's ROE collapses to 5.8%, resulted from margin compression from 12.6% to 6.7%, compounded by declining assets, turnover, and reduced leverage. All three DuPont components moved unfavorably. This composition proves that there are multiple paths to ROE generation, but margin management appears most critical in this industry. Now let's take a look at balance sheet quality. A vertical analysis of the balance sheet reveals both scale and composition differences. Ultratech's total asset of 1.34 lakh crore are approximately 5 times larger than competitors' massive scale that provides procurement advantages, geographical diversification, and market power. This scale supports their revenue dominance. Examining asset composition, Ultratech has 57% of asset in net PP, very capital intensive, consistent with their aggressive expansion strategy, whereas Shree Cement shows 22% in PPS, suggesting either a light asset model or possibly outsourcing arrangements. ACC sits at 34%, which is moderate. This composition differences help explain our earlier efficiency findings. Lighter assets bases can generate higher turnover ratios, but may limit absolute production capacity. This represents a strategic trade-off between efficiency and scale.
Let me summarize our key analytical findings applying the FSA concepts from class. First, Ultratech maintains undisputed market leadership with revenues exceeding 75,000 crores and stable fundamentals driven by scale and leverage. Second, sector-wide margin compressions from FY23 to FY25 affected all players, with ACC experiencing the steepest gross margin decline but recovering strongly at the EBITDA level. Third, Shree Cement exhibited significant operational volatility. EBITDA margins swinging from 26% to 16% raised red flags about operational stability that required management attention. Fourth, ACC emerged as the efficiency and ROE leader in FY25 with 13.1% returns. Our DuPont analysis revealed this was margin driven, demonstrating successful operational turnaround despite smaller scale. Fifth, asset turnover analysis showed ACC's superior efficiency at 0.82 times versus peers at 0.65 times, proving that scale alone does not guarantee efficiency. Our final assessment, While Ultratech's scale advantages remain formidable, ACC has demonstrated the strongest operational improvement trajectory. Shree Cement faces near term challenges requiring stabilization. Thank you.